Hello, my name is Magnus Petersen. This is a short demonstration on how to value a share issuance to pay for an investment. You can download the spreadsheet by clicking on the link below the video. First, we have to enter some data for the company. In this example, we will assume that the number of shares outstanding is 1 million and that the share price is $50. This means that the market cap, that is the market value of all the company's shares, is $50 million. The intrinsic value to long-term shareholders is the excess cash that could be paid out as dividends today, plus the present value of future earnings that can be paid out as dividends in the future. In this example, we will assume that the intrinsic value is $60 million, which is more than the market cap of $50 million. The intrinsic value per share is $60. Now assume that we want to make some investment. This could be the acquisition of another company, and we have to pay some of the purchase price in shares of our own company. So we have to issue new shares, and let's say we have to pay $5 million in new shares, and we have to make a cash payment of an additional 1 million, so the total payment is $6 million. We assume that the intrinsic value was greater than the current share price for the company, so we are actually giving up more value when we issue new shares. We are issuing 100,000 new shares for the current market value of $5 million, but the intrinsic value of those shares was actually $6 million. So in reality, we are paying $7 million. Let us assume that the present value of the return on the investment is $8 million. The question is then if the return on the investment is big enough compared to the intrinsic value of the shares that we are issuing. The intrinsic value per share after issuing new shares and making the investment is $60.91 under these assumptions. And this is 1.5% higher than the intrinsic value before making the share issuance and the investment. The equilibrium share price is where it doesn't matter to the long-term shareholders of the company whether we make the share issuance and investment or not. So we can try and enter 42.86 up here, and then we see that the intrinsic value per share is the same before and after making the share issuance and investment. And if we try a share price that is lower, then we see that the share issuance and investment causes a loss of minus 0.7% in this case. This is because the share price is now so low that we are giving up too much intrinsic value to make the investment, and the return on that investment is not big enough to justify that. Let us set the share price back to $50. The equilibrium can also be expressed in terms of the intrinsic value. So if we try and change the intrinsic value to $70 million, then we see again that it doesn't matter whether we make the share issuance or not, because the value is the same for the long-term shareholders. Once again, if the intrinsic value becomes higher than the equilibrium, then it destroys value to long-term shareholders to make this share issuance. For example, if the intrinsic value is really $80 million, then there's a loss of 1.1% if we make the share issuance and investment. Let's set it back to 60 million. The equilibrium can also be expressed in terms of the return on the investment. So if we try to set that to $7 million, then we see again that there is no difference in whether we make the share issuance or not. The value is the same to long-term shareholders. If the return on the investment is smaller, say $6.5 million, then the share issuance destroys value corresponding to 0.8%. You can download the spreadsheet by clicking on the link below the video.